Good morning, traders. It is Tuesday, November 4th, 2014. It's election day here in the United States. Go out and vote. It is about 8:01 a.m. Chicago time. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. As you've probably become accustomed if you've been listening to this for a while, it's the same routine every day. Very routine oriented. It's very important for a trader to just follow the same process and modify the process as we go along. So it's an evolving thing, but it's important to go through the same process. So if this sounds repetitive to you, it's intended to be. Spain's unemployment rises for the third straight month, came in at 79.2 versus 79.2 thousand versus 73,000. That's quite a bit higher. The disinflationary pressures remain intact as oil hit three-year low in electronic trading overnight. I believe oil got as low as, I heard 75. I haven't looked at an oil chart. 75.84. It's trading 77.44 right now. The EU Commission outlook, autumn outlook cuts GDP and inflation forecasts for both 2014 and 2015. Eurozone September PPI came out at 0.2 versus 0.0 expected, which is slightly better. Year on year, however, it's still negative 1.4 versus negative 1.5 expected. It's still negative. The US dollar settled down after the dollar index hit a four-year high in yesterday's session. Four-year high in yesterday's session. That partly explains the price of crude oil, as it's dollar denominated. The stronger the dollar, the cheaper the dollar denominated commodities, dollar traded commodities would be. September trade balance came in at negative 43 billion versus negative 40.2 billion expected. The S&P fair value today is expected at negative 5.9. This means that the cash is trading 5.9 points higher than the futures. If you're using a cash chart to do your homework, you need to do the math there to figure out where the futures are to be. Looking ahead today at 8:45, we have 8:45, which is 15 minutes after the open. All times are central. I am in Chicago. At 8:45, October ISM New York. There's no estimate. The prior 63.7 is a low tier release. At 9 o'clock, September factory orders comes in expected at negative 0.5% versus negative 2.1% prior. Also at 9, we have November IBD tip, economic optimism expected at 46 versus 45.2 prior, and possible revisions to durable goods orders. And it looks like we have four-week T-bill auction at 10:30. And then other than that, we have the weekly API oil inventories at 3:30, which is 15 minutes after the pit closes, half hour after the cash closes in the U.S. Tonight, just so that if you're watching the Asian session, tonight we get the China October HSBC Services PMI. There's no estimate. The prior's 53.5. That comes out at 7:45 p.m. Central Time. 7:45 p.m. Central Time. And then also this evening at 8:30 Central, Bank of Japan's Crude speaks in Tokyo. It's going to be important given the steps and the moves that have been done by the Bank of Japan recently. Again, I want to remind you, it's November 4th, midterm election day. Get out and vote. It's your right. If you're here in the U.S., I also want to remind you that there's a seasonality that exists here on elections. On election day, the seasonality has been, and again, past performance, not indicative of future results. This is more of an interesting to note type of point of view. There's been a positive skew on on election day. The market has tended to be higher the day of or for the rest of the week following election day on the indices. So take that into account. This is a seasonality that goes back to the 1950s. Other than that, not much else. We're going to look at charts. Let's see what the market has done. If you recall yesterday, from yesterday's Trader Bite, the idea was that the market, and I had to pre-record that, I had to record it very early, in fact, about an hour earlier than normal. At that time, the market was trading closer to the overnight low than the overnight high, and definitely below the overnight VPOC, I believe. I was missing some data from the chart because of the daylight savings time switch, and I had to download the information. But yesterday, when the video was done, we were down here, and the expectation in any case, given the new highs put in the prior day session, which is this gray on gray in this chart, gray on blue is the overnight. As you see here, the overnight session versus yesterday's day session. The expectation here was for a test higher, but I expected it to drop lower down to 206. 2006, 2005 was the key area. 2005, if you recall, 2005.50, if you recall, was a measured move target, and has a couple other things in play. And that was the goal yesterday. The expectation yesterday is that we would test higher early, then find sellers like we've been doing for quite some time now with new highs for a push down into the 2006, 2005.50 and a potential test of 2002. There's a gap between 2002 quarter and 1994 quarter that was left behind from Friday. Friday is a little island on its own at new highs. And so I expected the market to push lower. That was the higher probability play. That was the Trader Bite. By the time we opened, as you see here, by the time we opened, the market took off. There's no way for me to predict that. The market just turned around and just rallied back up into 2016 and a quarter, which reduces the odds of that plan, my primary hypothesis, playing out. And that's why I do these videos at 8 a.m. to 8:20 a.m. Just 10 minutes. They finish 10 minutes before the open. It's because I need this information here. As the bond pits open and treasuries become active, there's an influence on the market, which I didn't have. So here we ran up into new highs again, and then we opened a very two-way open. Pretty boring trade yesterday. There was some range expansion on the prior day, but not too much to speak of. But essentially, let's run this back just the way it traded, just so that you can get in line with the story. I cannot overemphasize how important it is for me to walk through the market like we're about to do. It helps me get into what we call the zone or the flow of what's happening, what has happened, so that I can get a better idea of what's likely to happen. And then my job then is to wait for the market, and I emphasize wait for the market to tell me what it wants to do on the open, keeping in mind what releases are coming through and may cause revaluation of the product that I'm trading. And then once the market tells me which plan it likes to go with, which hypo it likes to go with, then my job becomes to identify an area to get in, and with a stop or a risk level that is harder to get than my first scale. That's really the holy grail right there. I just recited it to you, and it's free. So we open auction out of range, traded back and forth, put in an opening swing low, very clean opening swing low at 2012.50, the closing swing low, high from Friday. and then pushes through to 2015, where we find the sellers. The sellers step in and take us right across the opening swing, which is what we want to see. A retest of 2013 and a quarter tells us it's likely to push lower into this point of control, this naked point of control, 2010.50. It tries and tries and tries and is unable to, pushes back up for a double top. Here's a triple top. The likelihood of this holding is very, very limited. So the idea for a push down to 2010 and a quarter did not work out here. So we take the loss and just move on. But now we have a triple top, and the expectation is this triple top will break, as more likely to break. There's a very, very high probability. When the market tests and retests an area, that becomes a weak high, and it's likely to break up. That's just a statistical study that I've done and reviewed over the years. Here's a top at 2017, a small double top again, weak high, and then the market's just completely sideways, auctioning both ends, both sides. There's nobody. I did not see any intermediate or high time frame control here. It seemed like mostly local to local, and it's just floating around and just standard rotations and price discovery. Finally makes it through to 2010-25. Not the easiest trade around. We still have a weak high at 2017, so the expectation is that's likely to be tested at some point. And here's the market just sitting in the middle. The shaded area is the value area based on volume as the day develops. The pink line that you see dropping and going up, that's the point of control, or the most traded price of the day. The value area is based on the point of control. As the point of control drops, the value area might drop. As the point of control rises, the value area might rise, depending on the shape of the profile and its ability to represent the first standard deviation, or 70%. In either case, so far we're trading right in the opening swing. The point of control is right in the middle of where we're trading. The mid is right below us. VWAP's right below us. This is just a chop fest here. The delta is strong, so the 2017 has a better opportunity being taken out than the 2008. So the expectation here is for higher highs. That's what was expected for this day. We're given the weak high that we put in, and the fact that we pushed through and down into this value area and have come out of it, then the expectation is for it to push higher. It just takes a lot of patience. Here it's starting to break higher, and boom, there the double top, the small double top and weak high are now taken out. That statistic is fulfilled. Pushes to 2019 and a quarter, and then again it fights both ways, and then it finally starts to move back lower. What we have here is what's called a failed auction. We see a move the other direction. This is actually a setup. Tough to get right away, but when you train your eyes to it, it becomes a pretty decent area, a pretty decent thing to look at. A failed auction is when we move to an area, take it by a tick, and we're unable to trigger stops or find sellers, and then those who came into this looking for the break lower start to cover, and then you get a strong move the other way. Products like the DAX, the Russell, do that a lot. So we have buyers here on the close. As locals or whatever day traders start to balance out their books for margin, and the market closes right in value. Pretty uneventful day, other than the fact that we pushed our high to 2019 and a quarter. I think I have a measured move up at 2020 and a quarter. We missed it by about 4 ticks, and then looking at the overnight, it has basically not gone anywhere. It started to float down. We tested the point of control to the tick overnight. That's no surprise there. We have basically, we completed with the low at 2006 and a quarter. We completed this this impulsive move down that we had during the day. This is the completion move, and then from there it's just been sideways. We had another impulsive move down 2005, expected a completion move or continuation down to 2004.50, and now we're sitting at the point of control, which is below yesterday's range. So what this is doing What this is doing is it's executing on the plan that was intended for yesterday. Again, I was looking for the market to drop and examine lower prices, possibly fill in the gap to find buyers. Remember, the market moves down to find buyers. It goes up to find sellers. No, it does not move up or down to screw you out of your money. That's just I just don't accept that, and I didn't for my prop traders either. We're not victims of the market. The market's there to facilitate trade and to bring together as many buyers and sellers as possible. The market's goal is to create this. Please remember that the market's goal is to find balance, because that's when a lot of inventory changes hands, and that is the goal. The goal is to marry as many buyers and sellers, or not to marry, to bring as many buyers and sellers together to transact in a market. The market's constantly seeking balance, and the market moves out of balance when it needs to revalue. So that's what a gap is. A gap is the market moving out of balance to revalue. You can see that after a gap, very often we find ourselves in a balance zone. That's just a market that's very efficient. It has moved into a new area, deems it to be value, it stays there, and it trades quite a bit at those prices. When the market cannot find value, you have a day like this where it's consistently seeking value, and we call those trend days. But all it's doing here is it's advertising for higher and higher prices, the goal here is to entice sellers to step in. If enough sellers step in, you have a market that's got sellers that are meeting the demand, and then you have a point of control that forms in a shape that is more balanced, and the market has done its job. Okay, it's really important to look at trading that way, because that's what it does. If you go to an auction, that's the goal. The goal is to try to find the price that moves the inventory and move on to the next thing as much as possible, except auctions are not two-way, so you don't have pressure to push prices down. You only have pressures to push prices up. Understanding the auction is very, very important. I've got a lot of material on that on my website, on old videos in the chat archive. Just browse through there. It's free. It's all there for you to take. And I would suggest you take the time to look at that if that is not how you see the market. The overnight high is 2013.75, just above the 2013 high we put in on Monday. The threat of a push higher on the open does exist. We are kind of stuck in this area. This looks like a long liquidation profile here. Yesterday's was a bit of a long liquidation profile, kind of centered in a way. It's not a B-shaped profile, but in general, the market is bringing in this long liquidation or B shape, except this one doesn't qualify as a B shape, as the B shape happened early on. It's when you sell off and then go into balance that you have long liquidation. Here, the market just rallied on the close, but we keep getting these B-shaped profiles, with the belly at the bottom. And it's signaling long liquidation or weaker buyers. So my expectation is still the same. It has not changed. My expectation is, again, to come in, test higher. One of the things that needs to happen here, because we've had 2 days of balance, is to draw a profile around these 2 days and identify where the point of control is. The point of control for this, it looks like we traded 91,000 contracts here at 2010 and a quarter, and the market's trading 2,750. That becomes the over/under line, and I'm looking for the market to reject, to potentially test through 2010 to yesterday's close, which is 2011, and then I'm looking for a seller to step in and fight from 2011 to 2012 and a quarter and fight the push up and look to push prices down and into the 2002 area. I expect the overnight low to be taken out more more likely than the overnight high, but we'll see what happens. Again, I always come in with multiple trading plans, and my job is to figure out which one the market likes. The second plan is that the market is that we come in, we're opening just out of range. If we hold here for the next 8 minutes, we test lower, we're unable to find any selling interest into the 2005-50, 2006 area, and then we start to move up into 2011, 2012, and then we are likely to sit tight and chop in yesterday's value and build value again in this balance zone. However, I think there's a much better opportunity given the overnight action and the way this thing's been trading on the sell side for the market to test up early 2011, 2012 quarter area, and then to find sellers up till 2013 for a push down through and out of yesterday's range, and to start moving towards 2005-50 again, and 2004-50, and so on and so forth. The goal being this gap zone, which I have yet to mark, the gap zone between 2002 quarter and 1994 and a quarter. Okay, that's the key plan. Before you leave here, don't leave yet. Before you leave here, I just wanted to take a quick look at crude oil. This is a 30-minute crude oil chart. Crude oil is reaching the levels it was at starting at in February 2009. I've had to pull in a lot of data, and there's an important milestone here. At $79. At $79, what you have is a profile that has single print extreme down here. We're biting into that extreme. Crude oil, those who are bullish crude oil, right now that takes some guts, will want to see the market recover $79 and start to push through. If it does, then you're looking at a most likely test of the 82 CHVN for a trek to 83, but they need to recover the 79. If they don't, then there's a lot of pressure on crude, and there's a lot of resistance here in the 79.50 area. You can see at 79.50, 79.43, 79.50, 79.50, all holding this down. So to me, crude oil, the over-under line in the short term over the next day or two in crude is likely to be 79.50. If it gets above there, then you're looking at 82 right here, this CHVN 82.20, 83, and then it starts working its way up there. I doubt that it does, though. It looks like production is not going to get reduced by Saudi and other countries controlling supply. The U.S. is coming online and has been producing oil as well, so that's not going to stop immediately. So I think overall the picture here is that we're likely to work through this buying tail we left behind from February 2009, and it'll force me to bring in more data. I'll be forced to go to a much higher time frame chart and go back in time to find substance beneath this 77 area. So this is a pit only chart. That's all I'm interested in. Oops. All I'm interested in for crude, and that's how crude lays out right now. Good luck. Please watch your risk. It's there's not a single trade out there that's worth risking more than a couple or 3% of your account on any one trade. Put your risk first so you can stay here long enough to figure out the kinks and to achieve your goals as a trader. Good luck and take care.